Hello student, welcome back to IBS. Today we are going to learn about cash flow statement part third. Now we are going to learn about the some of the limitation of cash flow. The first and foremost important limitation with regard to cash flow is a statement only reflect the cash flow and does not reveal issue like unpaid payable. For example, positive operating cash flow like in a statement of cash flow, net income, then your operating activity, in that it is showing positive. Why it is showing positive? Because you have huge payable or something. So in accounts payable, if you are keeping your invoices unpaid, you are not paying your invoice and you are delaying, so what is the result? It means you are not burning your cash, you are saving your cash, but this you have to pay, right? It is your obligation, you have to pay. So ultimately your current liability is high, since as per the rule of a statement of cash flow, all your accounts payable will be added back to your net income. There is logic which I have already discussed. We keep cash in mind, since we have booked the invoice, we have not paid, so we have not burned our cash. So they can use it in direct way that they cannot pay, so that while closing you will see, you will add back this into your cash, into your statement of cash flow. Then operating activity will show positive, but you have due. But this is giving the indication to your external user that your company has good business and they are generating good cash. So these are the message will mislead the information. So this is the limitation. I hope it is clear to you. So as I have discussed this also, the same point they are saying, when you have such kind of issue or limitation, sometimes you may be misled by reading a statement of cash flow and other things. So that is why you should fully understand the company financial condition. By you need to consider like balance sheet, income statement along with cash flow statement. So these all statement will provide you additional context such as outstanding liability. In terms of this only he is talking about. But my point is, if you have good understanding of all three statements, that will give you real understanding, and you will be able to, this kind of limitation you can overcome by your understanding. Well, not only checking this point, if you will check and you will see that whether they have accounts payable is and keep on increasing. Okay, so you can go deep down into the income balance sheet and you will see that last 4 or 5 year and what is their accounts payable position. It is keep on increasing or something, what exactly is happening. So this kind of limitation we can only avoid when we have information and we have ability to deep down into the GL and the current liability section and understand it. So when you join any company, initially you may not understand everything, but after working long time you will be having, while seeing the figure, you have backup information in your brain already, so you can easily understand what is happening and where is we are lagging behind, kind of stuff. I hope it is clear to you. Another limitation of indirect method is we directly add or reduce from our operating or from net income, but we don't go with the detailed information and the user of those like unpaid liability, like account receivable. So in detail we are not creating, because this is indirect method, this is the process we follow. So this is why that is being considered as a limitation, because we are just keeping in total AR value into our cash statement of cash flow. So this like AR total value will not give you overall idea what exactly is happening unless you know the AR aging report. So then only you will get more robust and comprehensive information. So this is the drawback. And if you follow the direct method, they are putting all the line item, everything, so that is more detailed. But normally industry and everyone prefer this method. Reconciliation requirement: indirect method includes reconciliation of net income to cash flow and operating activity, making it simpler to prepare. Indirect method although prefer clarity, required more detailed reconciliation is commonly used, as what we have discussed just now. Preference for direct method. So what does it mean? Direct method benefit, if you talk about, it provides more clear view by directly listing cash receipt and payments, offering more detailed insight into the cash flow from operation. As I told you at that time, they are listing all the cash inflow and cash outflow related stuff into the operating activity from your operation, where your cash has come, where your cash is going out. Indirect method are actually more commonly used, and due to his simplicity and simplicity for preparation, okay, and the requirement for reconciliation between net income and cash flow from operating activity. So this is why indirect methods are more preferable. I think we are done for the day. We'll see you into the next session. Stay tuned. Thank you very much.